Well, hello there, everyone. Welcome to another edition of Tip Tuesday. Geoffrey Nance here with you again. Today, we are going to be beginning a short little series here about some of our advanced strategies. Now, generally, we teach these strategies over a 2-day period. So, certainly, our intent will not be to teach you these strategies nor how to do them, but we are getting geared up for what we call our Boot Camp 2.0. This is an event that happens like during the day from 9 a.m. to 3 p.m. Central Time, and it's going to be in about 3 weeks. So if you haven't received any information about that, feel free to contact support at tradeway.com, and you can get some more information about that. But we certainly want you to be able to attend that if you would desire to do so. But we're basically going to be going through how to use these strategies and in certain situations, mindset. We're going to be dealing with a lot of those things. But what I'm going to be doing over the next several weeks is just giving you a general broad overview of what is a debit spread, or what is a credit spread, why do we call them those things, why do other brokers or financial teaching seminars or speakers use different terminology. So we're going to talk a little bit about that. And then we're going to talk about why it matters. Why would you want to learn how to trade those things? What are some of the pros and cons? So we'll be doing that here over the next couple of weeks, just kind of giving you a broad overview, kind of whetting your appetite, and then hopefully enticing you to want to continue your education so you can learn more about what those are and how they work. So first off, what is a debit spread? Well, the word itself, debit, means that you are paying for it. So if you were buying a straight stock, step one, that would be a debit too, right? So anytime you have a debit, it means that there's money coming out of your account. So first off, that's pretty simple. That means that you are going to be paying for this thing. Now, you might be thinking, well, don't I pay for basically everything I do in the market? It might seem that way, but next week we're going to talk about a credit spread. So there actually is a way for you to get paid by entering a trade. What? So that's pretty cool, but we'll get to that a little bit next week. But for now, debit spread. So what's the second part of that? It's a spread. So it does involve options trading. So if you've never been through any options training, of course, you're going to need to have that as your foundation. It is an option strategy that involves two legs. And what do we mean by that? So generally speaking, if you hear somebody saying I'm going long or I have a long leg when it comes to trading, basically that just means that you're in a position where you bought something. So you bought to open. It could be a stock. You could be long the stock. You could be long a call option, and you could be long a put option. Basically, again, it just means that you bought that thing. So that would be your long leg. And then it involves a short leg. And a short leg is something that you sold. So when you entered that particular position, you sold to open. That is your short leg. So a debit spread involves both a short leg and a long leg. So two option positions, but you're going to combine them together. So you'll be buying and selling at the same time. And then, of course, when the trade was over, because you said, hey, I'm good with the amount of money that I made, the options had expired, or you said, you know what, I need to stop out of this trade, you would reverse both legs, probably, particularly in a debit spread. There are some rare occasions when you might consider, hey, I'm not going to reverse both legs at the same time. But most of the time, you would reverse both legs at the same time. Your broker would do that for you, essentially, once you entered the order. So you can use these in what fashion? All right. Well, basically, the benefit of the debit spread, probably the biggest one, is that you have the potential for very high return on investment. So if you ask most people, what is your favorite thing about a debit spread? It's like, wow, I can use a little bit amount of money and potentially make a big amount of money. So I could make 100%. I could make 200, 300, 400, 500, 600, 700% on one trade. Well, obviously that in and of itself is fascinating. I mean, just the very thought that, oh, well, how long would it take? A couple of days. What? A couple of days? You can make 100, 200. So that in and of itself is probably, I would say, the most fascinating element of the debit spread. Number two, it allows you to really take advantage of smaller moves within the stock or the overall market. So let's just say a stock was only going to move, say, maybe 50 cents. You might look at it and go, yeah, that's not worth messing with. I'm not even going to roll out of bed for a 50-cent move. Well, if the options are available and your particular stock has 50-cent spread strike increments, then you can actually take advantage of that. And let's just say that you come to the next advantage. Generally speaking, debit spreads cost considerably less, obviously, than owning the stock. They cost much less than just buying an option like we would teach at step 2. They do, at least the way that we teach them, tend to be short-term trades. You could make it a longer-term trade, but for most of ours, they're going to be shorter-term trades, a couple of days to maybe a couple of weeks. So there's that element to it as well. But basically, let's just say you might be paying 25 cents per share for the potential to make 25 cents a share. Or you might pay 30 or 40 cents a share to make 60 or 70 cents per share if the stock moves $1. So let's just say we did. We got into a trade. We had a difference of $1 between our strike prices, and it moved, closed out the end of that week. Both legs were in the money, that kind of thing. And you said, all right, wow, how much is it worth? Well, worth $1. What did I pay for it? I paid 40 cents. What's my profit? 60 cents. So I paid 40 cents and I made 60 cents. So that's $400. I brought in $600. It's a 150% return on investment. How long was I in that trade? I don't know, 4 or 5 days, maybe less. Now here's the upside to this. This may sound a little crazy. That actually, if you're in it for less time, the return on investment might actually be higher. So your return on investment actually tends to be lower if you actually have more time. So how does that benefit you? Well, let's just say ideal scenario. I can find a particular stock that I feel pretty confident is going to make a particular move, but it's only going to require a couple of days to make that said move. Using a debit spread provides me significant leverage to be able to go in there and say, wow, I can pay maybe 15 cents and make 35 cents on a 50-cent move. I might be able to pay a quarter and make 75 cents on a $1 move. And we're just talking about, again, smaller moves here, guys. We could easily do a debit spread with stocks that move $2, $3, $4, $5, $10, $15, $20. There's not a limit as far as the potential movement of how you could apply a debit spread. But why is it a big deal? Why should you want to learn more about it? For the reasons that I've mentioned. Now, how can you learn to implement these? Because timing is an issue. So now that we've talked so much about the pros and the positives of a debit spread, let's talk a little bit about some of the negatives, because that's fair, don't you think? Right? That we should not just mention the positives, but also the potential cons. What's the cons of using a debit spread? Well, because they do tend to be shorter term options, if I don't get the direction right quickly, I can lose a high percentage of my money quickly. So what we have on the pro side is, wow, I could have a really high return on investment and I could make it in a really short time. We also have to consider the downside of that risk return principle, right? The more I'm willing to risk, the more I could potentially make. Well, debit spreads exemplify that very clearly, because now you're sitting there going, wow, I could make a lot or at least a high return on investment in a short amount of time. Well, what's the downside? Well, I could lose a high percentage of what I put into this trade in a short period of time. And if the trade doesn't turn around and doesn't really do what I anticipated, I can in fact lose all the money I had in that trade in a very short time. So becoming a good debit spread trader does require a couple of things from you. One, it requires that you understand what I just mentioned, that there is a high probability that you could lose a high percentage of your investment if you don't act quickly and reverse and stop out when necessary. In fact, you could lose everything you had in that trade. So obviously, we don't want you putting a lot of money in these trades until you've got a pretty good track record of making money on these and understanding how that movement over time does impact your ability to both make and potentially to lose money, because both of those are realities when trading stocks and options. All right, so what's another con to this? It does require timing, right? That's kind of important with debit spreads. This isn't kind of one of those things where you're like, hey, let me just hop in a debit spread and just kind of see what happens somewhere out in the future. Not really how that works. So with a debit spread, you do have to have a time to expiration in mind. So there is an expiration to these options, and you kind of have to have an idea of what. So what are some of the three things? All right. So one, I've got to know what the movement is likely to be. So becoming a good debit spread trader requires that I understand movement over time, and that I'm really good at executing this at the right time so that I get the lowest possible price, because again, it is a debit. So I want the smallest price for the highest potential profit, because there is a cap on what I can make. Okay. So debit spreads are capped on what you can make, but that cap is pretty sweet when it comes to the potential return on investment. So the downside is I have to be pretty good at understanding timing, and I have to be good at understanding movement, because I want my stock to move enough so that I've kind of covered that area, but not way more, because that means there was money I could have made and I just kind of left it out there because I didn't have a wide enough spread. So understanding movement, understanding time, how those things come together, and of course, patterns, market tone, fundamentals, everything that we've talked about with you guys all the time, of course, are still going to be in play here. So if you're interested in learning more about debit spreads and how they can benefit you, sign up for one of our classes, because we go into much more detail. Now, I've spent about 15 minutes here, really about 10 minutes, talking about them. But of course, there's so much more to cover. We've got to do some math here, show you some pros and cons of, what kind of timing do you need? What's the best for that? What your entry, your exit. We got to go through all that stuff, and we will. And that's what we like to do. We like to teach. We like to give you guys tools so that you can use those in the market at appropriate times. Oh, and by the way, one other benefit I failed to mention, you can do these when the market is going up. So when an individual stock is going up, or you can use them to make money when a stock goes down. So you can use debit spreads for movement up and movement down. So there's another benefit. So if you want to learn even more about this stuff, you guys certainly can do that through our courses available at Tradeway. Check us out at tradeway.com. Or if you want to sign up for your Bootcamp 2.0, just email us, support@tradeway.com. We'll give you some more information about what that looks like. And that's our tip for today, guys. Debit spreads are an incredible tool, but just like any tool, you have to have the knowledge of how to use it correctly. Otherwise, something that could be great could end up hurting you, and we don't want that for you. We want you to do great. So in order to do that, you need to have a good understanding of what the tool is, but also how to use it properly. So make sure that you do invest in the education so that you can take advantage of the tools that are available. And that's our tip for today. We'll see you guys next week.